I want to start with BlackRock slashing the value of the private loan to zero just 3 months after assessing it at 100 cents on the dollar. It's not a big loan.
Absolutely, yeah.
But $25 million is a lot of money for a lot of people.
In the scope of the money that BlackRock manages, it's not a big deal.
But what does it signal to you and to us?
It's BlackRock.
Look, it's BlackRock. It's one of the most sophisticated professional managers out there. You know, when I was a cub reporter covering credit, I learned one thing. Like, in credit, you have a good day if you're making your coupon and you're not losing any money. So for a loan to go from 100 to zero, something really dramatic has had to happen to the company, or something really wrong was with the original underwriting. So that's why the situation, it's the second one that BlackRock has had in this private credit fund, kind of matter, even though they're small.
How do you kind of cross? Because things that we heard at Invest, things that we are hearing in general when it comes to private credit, and I'm always a little skeptical for people who are, maybe talking their book, that they're going to be careful.
Fine.
But I also know they also have fiduciary responsibilities too, right? To their investors too. But I don't know, what was your takeaway, especially after Bloomberg Invest? You talked several panels and talking to people in the midst of this.
I think the message is pretty consistent. You just had David Solomon. He summed it up pretty well. Like, the portfolios overall and the returns of the funds are actually performing well. There have been situations, idiosyncratic, where we've seen losses, and those matter, and we should pay attention to them. I think what they bring to the fore, though, is a broader kind of underlying concern about the quality of the valuations and the marks, particularly in private credit. That's a concern that people have had for a very long time.
Right.
And now they're getting spooked when they see loans drop so fast and so dramatically. They kind of worry about what else is out there that we're not seeing yet.
Well, why are the loans dropping in value so quickly? Is it because people are having trouble paying them back?
It's a combination of issue. I would say that this one we wrote about recently was in a space, Amazon aggregators, that had a tremendous amount of disruption. So this is not something that's happened yesterday. It's a sector that's received a lot of capital back in 21, 22, and since then has performed really poorly across the board. And BlackRock had flagged this in their filings, that there was going to be a big write-down. They wrote down the value of the entire fund by 19%. So when you look at the individual loans, that's not a big deal, but 19% of the entire fund starts becoming like a bigger issue. So it's a combination of like companies that weren't performing well and maybe managers were slow to recognize problems. And just the reflection of the underwriting environment that we were in back in 2021.
Well, that's what I want to go. How much of is that? How much of this was the underwriting happened when money costs nothing? And so a deal that looks good when rates are at nothing look great, but not where they are today. How much of it is that? How much of the loans were written back then, and that's what we're dealing with?
Yeah, I mean, I think we've heard Lloyd Blankfein talk about that point too, like the kind of behavior that sets in towards the end of a credit cycle when money is easy, and you're kind of under pressure to make more loans because you have capital to deploy. And so we have seen a lot of situations in 21, 22 that turned out to be very bad deals. And that cuts both ways. It's not just the private markets, it's also the public markets. And you've seen banks suffer from that as well.
So Davide, at what point are you going to be there sitting here writing that the contagion has spread?
Into the wee hours over the weekend.
And not a prediction for when that happens, but the signal that will tell you that, okay, this is something bigger.
I think what everyone is focused on right now is liquidity, especially in the private credit portfolios, where you've seen investors try to redeem their shares. The other piece of it is all of these funds have leverage. So there are bank lines.
Right.
At some point, if a lot of the money from the retail investors, that's the equity, comes out, you need to see a readjustment in the amount of leverage and borrowing that those funds can support. I think we're far from that.
But bank earnings are always opportunities to see, right? Because of their exposure.
I think it'll be interesting to watch the language from bank executives around that space for sure.
Davide, thank you so much.